And so you can put as little as 5% down. And now actually Nova Scotia, the government has a program where they'll lend you that 5% interest free that you pay back over 10 years. So you technically can have a 0% down mortgage, but the one caveat to that I will say though is closing costs. You still have to cover them. You want to budget at least probably 2.5% to that. But yeah, you definitely don't need 20% down. Some people have it, some people don't. I'd say probably 90 to 95% of current first-time home buyers, don't quote me on the stats, but they're putting 5% down or maybe 10%. Over the run of the mortgage, over the amortization period, the full life of the mortgage, you're going to pay more interest to the bank or to whichever lender the lower your down payment is. Just because your mortgage is higher, more interest accumulates over the period of it. Each case is different, and as a mortgage broker, we like to have that conversation with the client up front about their personal life circumstances and their personal goals, because you kind of have to shape it around their life. You probably want to budget 2.5% of the purchase price for your closing costs. When you're not dealing with the insurer and you're putting 20% down, there's certain programs that you can take advantage of.
Hi, Richard. How are you?
I'm doing great. How about yourself?
Thank you so much for being here. I have a question very important, because when somebody is looking to buy a house, they have the main idea that they need the 20% down payment. Can you say something about that?
It's definitely not true. And it's weird. I think that kind of stems from people. A lot of the content online about mortgages and buying properties relates to investment properties. That is the case for the large part when you're buying a rental property or investment property, that you do need 20% down. Some cases they're not, but we'll leave that for another discussion. But if you're buying your first home, I hate saying this sometimes, but you can technically put as little as 0% down. So anything under 20% down, you need default insurance. That's what they call it. And so you can put as little as 5% down. And now actually Nova Scotia, the government has a program where they'll lend you that 5% interest free that you pay back over 10 years. So you technically can have a 0% down mortgage, but the one caveat to that I will say though is closing costs. You still have to cover them. You want to budget at least probably 2.5% to that. But yeah, you definitely don't need 20% down. Some people have it, some people don't. I'd say probably 90 to 95% of current first-time home buyers, don't quote me on the stats, but they're putting 5% down or maybe 10%.
And what is the difference? Because if you put only 5% versus 20%, what is the benefit for you as a buyer putting more down payment?
Yeah, if you put more down over the life of the mortgage, you're going to pay less interest just because the mortgage amount is lower because your down payment was higher. But one thing I will say too, the benefit to putting less down, you do have the insurance premium that you're going to pay, but because your mortgage is insured, and when I say insured, there's 3 default insurers, and essentially they're guaranteeing the bank that the bank will be made whole if you screw up, essentially, and you can't make your payments. So because the bank has that guarantee, they'll give you better rates if your mortgage is default insured. But over the run of the mortgage, over the amortization period, the full life of the mortgage, you're going to pay more interest to the bank or to whichever lender the lower your down payment is. Just because your mortgage is higher, more interest accumulates over the period of it.
And for example, if I am trying to buy a house, is my situation the same situation than other people? For example, can I make a strategy especially for me, or especially to reach my goals? Is that possible? Talking about the mortgage, the down payment.
Yeah, I mean, every case is unique too, because it's interesting you say that, because a lot of times we find, this is fine, but a lot of times people use every single dollar that they have saved for their down payment. But sometimes that's not always the best thing to do, depending on your current circumstances. So say, for example, you're looking to buy a home, but you also intend on having a baby in the next year or two. Maybe you don't want to put all your money towards the down payment right now, because you're going to need a little bit to get that, to buy whatever you might need for the incoming baby or whatever other expenses you might have. So each case is different, and as a mortgage broker, we like to have that conversation with the client up front about their personal life circumstances and their personal goals, because you kind of have to shape it around their life. You might want to put all your money down towards the down payment to reduce the interest you're going to pay over the life of it. But it definitely varies case to case, and it's best to come up with a plan as early as possible as opposed to leaving it last minute, because we see that quite often too.
And in your experience, if somebody reach out to you today, is the people ready to buy a house immediately, or they have to fix some things in their finances?
Most times people have to fix some things.
Okay.
But I love that though, because they're smart enough to come to you early and ask you about it. And yeah, in a lot of cases, it's kind of setting up a plan of what they need to do next to be able to build themselves up and be ready to buy. Because even in some cases, we have clients where, we can get them approved for a certain amount, but they end up being what we call house poor sometimes. They're so stretched that even though they're technically qualifying, it might not be the best move. So you have to walk them through that. And sometimes, clients will have a financial advisor they're dealing with too, and you can have that conversation with them. But it's definitely the sooner you reach out to someone, the better. Because a lot of times too, we have people that, let's say this, they wanted to buy a house for the last 2 or 3 years, but they put it off. They didn't think they were qualified, or they didn't think they were ready. But then they came to us, and surprisingly, they were more than qualified. And they were ready to do so. But it's always good to check in advance or as early as possible.
And something that you said, it's very interesting for me, because probably you have listened that you need 20% for the down payment in order to start buying a house. And now you are telling me probably you need 5%. Okay? But what happens if I don't have it here in Nova Scotia? Is there any possibility to get in the market to start investing something in real estate without down payment?
Yeah, kind of what I was alluding to earlier, the Nova Scotia Down Payment Assistance Program. It does cover that 5%, so you can borrow that 5% interest free and pay it back over 10 years. Sometimes when people want to do that, it's, even if they do qualify, might not be the best idea. It might be better to save until you get to that point, but in a lot of cases, it still makes perfect sense. So yeah, you can. If you're buying your first home, you can take advantage of that program. If you want to buy it as investment property, no, you're not allowed. There's certain qualifications or restrictions that they have. So there's a minimum credit score, which I think is 650. There's a maximum household income, 145,000. So if you make over that, you don't qualify for that Nova Scotia down payment assistance. And there's a number of other factors, you have to be buying your first home, you have to be a resident in Canada. So yeah, it's definitely there for the taking, and can be beneficial. Because I'll give you an example. Another scenario where this makes sense is people have the 5% saved up for the down payment, but they also have debt. Say it's a line of credit or credit cards. Sometimes we recommend them pay off with that 5% they have saved, pay off those debts, and then take advantage of the Nova Scotia down payment assistance, because you're clearing out some other higher interest debts, and then you're taking interest-free debt from the government to use for the down payment. So it's netting out better for you. It's a good financial move. So in that case, it's really beneficial.
That's very important, because sometimes the interest rate in the credit cards or the car loans
Crazy.
Are very high.
Yeah.
And probably you can take advantage of this. A friend of mine bought a house, and she only had the 5% or probably a little bit more. And at the end of the day, she told me that it was not enough, because even when she had the 5%, she need to spend in legal cost,
transfer tax.
transfer tax, yes, the lawyer. And in that moment, she felt confused and without any help, because she didn't expect that expenses. So after the down payment, what other expense do you need to do in order to buy a house?
Big one's the transfer tax, which is about 1.5%. So that eats up most of it right away. Normally we say you probably want to budget 2.5% of the purchase price for your closing costs. And so normally upfront, that's checked by the broker or the lender to make sure you not only have the down payment, you also have the closing costs. Because in that scenario, that sucks. Then you're kind of left scrambling. You didn't think you'd have these costs, and you got to pay them out of pocket. So yeah, normally I'd say that the rule of thumb is 2.5%. You're going to want to budget for closing costs on top of your down payment. And just to reiterate too, because a lot of people don't realize this, that Nova Scotia down payment assistance we just touched on, you need to cover your own closing costs still, which is important.
So you need more money. It's not only 5%.
Yeah, that's right. That's right. Yeah. It's really more than that. It's more like 7.5%.
Okay, that's important. And do I have any benefit if I do the 20% down payment, or I have exactly the same conditions than putting only 5%? Is something different?
I like that question. You do. So like the main one is, like we just discussed, the more you put down, the less interest you're going to pay back over the period of it. Also, another thing to think about. So when you're getting approved for a mortgage, the two main things that the lender and us as the broker are looking at are your debt to income ratios, so your debt and your income. And when you have an insured mortgage, meaning you're putting less than 20% down, the ratios that they use are very strict. You cannot exceed them at all. It's got to be dead on. If you're putting 20% down and the insurer is no longer involved, the lenders are a little bit more lenient. If the situation makes sense, okay, doesn't matter if the ratios are a little bit out of line. So it gives you a little bit more leverage in what you're able to do. And that's not only beneficial for purchases, but also for refinances. Sometimes people are looking to clear out debt. And so the ratios might be a little bit out of line. And, because we're refinancing, it's not an insured deal. They're able to, exceed those ratios a little bit, clear out a ton of debt. And it's a big win. I'll give you another example too. So when you're not dealing with the insurer and you're putting 20% down, there's certain programs that you can take advantage of. One that I did recently was called like a net worth program. So this is where the lender, instead of putting the majority of the weight on your application on your debt to income, they consider your net worth a little more. So this can be pretty useful for someone that's, maybe they worked a salary job and they switched to being a business owner now, and their income's new, and the lender's like, oh, it's not really consistent yet, but maybe they'd already tucked away a bunch of money and they don't want to liquidate it. We can factor in their net worth a little more, even if their income isn't that great yet. So there's some little perks to it that you get that allow you more leverage and that allow you to have a little bit more flexibility in what you can get approved for.
If you were buying a house now, and if you have 20% for the down payment, what would you do? Would you pay that 20%, or what strategy should you follow?
Interesting. This really varies person to person. Me personally, if I had the 20%, I'd probably put the 20% down, just because you're going to avoid the insurance premium, and it's, you don't want to have to pay that, and you're going to pay less interest over the life of the mortgage. It is a lot.
4%, right?
4%, yeah.
Oh, my goodness.
It's not insignificant. The reason I kind of hesitated though is because some people are under the mindset of, and it makes perfect mathematical sense. They think, okay, maybe just put the 5% down, even though you get the insurance premium, but because your rate's say 4%, your interest rate, that other money that you didn't use for the down payment, you can put in the stock market and over the long run get 8 to 10%, which makes mathematical sense, but it depends person to person. Some people don't want to have tons of mortgage debt, and it makes sense. So it's kind of an emotional thing.
And I have a question. Is that true that if you do only 50%, there is like a scale or like a level of insurance that you have to pay according to the down payment that you do?
If you only put...
For example, if you put 5%, you must pay the default insurance. If you do the 20%, you don't. What happens if you pay 15%?
Right. Yeah, so it varies. The premium rate depends on your loan to value or the amount you put down. So I think it ranges from 2.8% to 4.2 or 4.4. So it's a bit of a range.
From the premium in the insurance or for the premium in the mortgage?
The insurance premium.
Okay.
Yeah, it varies depending on how much you put down.
So that could be a good strategy. I heard about someone who did the 90% of down payment.
Yeah.
And then when they got the mortgage, they pay off the rest and more. And
Right.
I don't know how that works.
They paid off the insurance premium, or just continued to
No,
pay off more.
the mortgage.
Yes.
She
Yes.
complete the payment.
Yeah,
I don't know why.
There are prepayment options that you have. Like with most the banks, your prepayment options are a little bit more limited, but with a lot of the monoline lenders, that just means they only do mortgages.
What is that?
Monoline lenders only do mortgages. You don't have a bank account with them. They don't lend to you for a car. They don't lend you for anything. Just mortgages.
Oh,
That's
okay.
it. So there's a lot of them actually that before I even started doing this, I wasn't totally familiar with. But a lot of times they have better rates in the banks and they're a little bit more flexible. So they are great to deal with.
Is what I heard, that you have two options to get a house, to get a mortgage. The first one, go into a bank and make your quote and get your financing, or go to a mortgage broker and have access to more lenders. Is that possible?
Definitely. I'm biased in saying this, but I always say you might as well go to a mortgage broker. It's free. So I think this is a common misconception too. A lot of people don't realize with a mortgage broker, it's the lender is paying our commission, so it doesn't cost you anything. You might as well go to someone that can check and see what every single lender has, right? And mortgage brokers we don't run on the typical bank hours, 9 to 5. We're available pretty much 24/7. Not all of us, but I'd say a good chunk. So it's nice to be able to deal with someone can always get back to you. And it's like you said too, we deal with the banks, and we also deal with tons of other lenders. I think maybe there's probably 35 or 36 that we have access to. So there's a lot of options there. Now, do we deal with 35 or 36 of them on a daily basis? No, but they're there. They're there for the taking.
And is there any chance to get a mortgage if you are not an employee, or you must be employed to get a mortgage and to be able to enjoy this 5% of down payment?
You can be self-employed.
Hey.
That happens a lot, and that's where some of the monoline lenders come in handy, because a lot of times the banks aren't a huge fan of self-employed income, especially if it's new self-employed. So sometimes with the monoline lenders, there's things you can do where they're not paying themselves a whole lot, even though their business is generating a ton. There's certain ways you can gross up their income, or the lender will factor in more or add back some retained earnings that they have in their company to improve their debt to income ratios and get them improved for more. Because they might really be making a ton of money. It's just in their business. They only pay themselves a certain amount because they're, you don't want to get taxed on too much, right? So there's a lot of options on that front too.
Okay, and talking about the down payment, what is the biggest mistake that you can see that people who is trying to buy a house is constantly repeating? The biggest mistake.
I'd say a big one is kind of what you talked about earlier, just forgetting about closing costs is a huge one. That's something you have to keep in mind. That's there because you got to pay it out of your pocket regardless. Even if you're going the Nova Scotia down payment assistance route, it's still there. And yeah, I'd say that's probably one of the only ones that sticks out. Just people forget about that when it comes to down payment.
Great, thank you so much. This information is very valuable. I hope to see you soon here.
Thank you, I appreciate it.
Thank you, Richard. And please tell me, where is the best place that people can reach out to you?
I'm on LinkedIn. I'm not a huge social media guy. I'm on LinkedIn and Facebook. Other than that, just by phone or email.
Okay.
Yeah, I'm not a big Instagram guy.
No.
No.
Me either, but now I have to.
That's fair for business.
Yes,
Sorry.
okay. Thank you so much, Richard. This is Richard Abbass. Thank you so much for being here.
Thanks again. I appreciate it.